Hello and welcome. Today, we are going to dive into a powerful financial strategy, one that many of Canada's most successful entrepreneurs use to protect and grow their wealth. So whether you're a business owner yourself, a student of finance, or simply curious about how wealth is really built in this country, you are in the right place. We're going to take what seems like a complex topic and make it clear and accessible. So the focus of our analysis today is the Canadian holding company. Now, that term might sound a little intimidating or overly technical, but I promise you the concept behind it is an absolute game changer for long-term wealth accumulation. We're going to explore exactly why this structure provides such a massive strategic advantage. Let's start with a foundational question. If you're building a successful business in Canada, what is the single biggest obstacle, the one thing that consistently erodes your profits and slows down your ability to build real generational wealth? What is that silent force working against you? Yep, it's taxes. For most successful businesses, it's the single largest expense, year in and year out. And that's precisely why understanding how to legally and ethically manage your tax obligations is so critical. You see, this isn't just about saving a few dollars. It's about maximizing the capital you have available to reinvest, to compound, and to grow. And that is exactly what we are going to break down. All right, let's get specific and really diagnose the problem. When your operating business earns a profit and you want to take that money out to use personally, you have to pay yourself. The moment you do that, those funds are hit with very high personal income tax rates. This means a significant portion of your hard-earned profit vanishes before you ever get the chance to invest it. To put a fine point on it, let's just look at a province like Ontario. The top marginal personal tax rate is a staggering 53.53%. Just let that number sink in for a moment. What that means is that for every dollar you earn above a certain threshold, more than half, more than 53 cents, goes directly to the government. It becomes incredibly challenging to accumulate capital when you're fighting that kind of headwind. Okay, so that's the problem, and it is a significant one. So what can be done about it? Well, there is a solution, a very elegant, well-established, and completely legal one. And it involves creating a corporate structure that uses what's called a holding company. So, what on earth is a holding company? Well, think of it this way. It's a corporation that doesn't actually do anything in the traditional sense. It doesn't manufacture products or offer services to the public. Its entire reason for being is simply to own things, to hold assets. Typically, this means it owns the shares of your main active business, and it also holds the investment portfolio built from that business's profits. It's like a personal vault for your corporate wealth. Now, this is the most important part to understand, how the money actually moves. So let's walk through it. First, your main business, your operating company, generates a profit. Now, instead of paying that profit out to you personally, where it would get hammered by high personal tax rates, the operating company pays a dividend up to its shareholder, which is your holding company. And here is the absolute key under Canadian tax law. That dividend payment between two connected Canadian corporations is received tax-free. The money moves from the opco to the holdco, and no tax is paid on that transfer. The cash is now safe in the holding company, ready to be invested. Now, you might be thinking this is all about deferring tax, and that's a huge part of it. But it's not the whole story, not by a long shot. A properly structured holding company offers a whole suite of other powerful advantages that go far beyond just managing your tax bill. Let's look at those. There's a lot to unpack here. First, and this is crucial, you get liability protection. We'll talk more about that. It can also help purify your active business so you can claim the lifetime capital gains exemption when you sell it. That's a massive tax break, potentially worth close to $1 million. We've seen how it turbocharges investment compounding. And on top of all that, it's an incredible tool for estate planning and efficiently transferring wealth to the next generation. It really is a financial Swiss Army knife. Let's just double-click on that liability protection because it's so important. Your operating company is out in the world, taking risks. It could face a lawsuit, it could have creditors. If you let millions of dollars of retained earnings and investments pile up inside that active company, all of it is potentially at risk. By moving those profits up to the holding company, you're building a firewall. The holding company isn't exposed to those operational risks, so the assets it holds, your accumulated wealth, are shielded and protected. Okay, the theory is compelling, but let's put some numbers to this. Let's quantify the advantage, because the true power of this strategy really comes to life when you model it out over the long term. So, we've built a 30-year financial model to compare the outcomes directly. So, every good model starts with clear assumptions. Let's lay out our two scenarios. In both cases, we have a successful business earning $500,000 in profit each year. In scenario 1, the entrepreneur just pays all of it out to themselves as a salary. In scenario 2, they use the holding company structure. They pay themselves a reasonable salary of $150,000 to live on, and the remaining $350,000 is moved to the holding company for investment. We'll assume a consistent 7% annual return for 30 years in both cases. So let's start with scenario 1, the traditional approach. That $500,000 salary in a province like Ontario triggers an immediate personal tax bill of about $225,000. Right off the top, in year 1, nearly half of the profit is gone before a single dollar can be invested. Now let's look at scenario 2, with the holding company. Here, the total immediate tax is much lower. It's the combination of the personal tax on the $150,000 salary and the corporate tax paid on the profit. The total hit, only about $85,000. The difference is just staggering. That means so much more capital is left over to put to work on day 1. So what happens when we let that initial advantage play out for 30 years? Well, this is where the magic of compounding really shows up. Without a holding company, the portfolio grows to about $2.1 million. Not bad. But with the holding company structure, because we were able to invest a much larger principal every single year, the portfolio swells to $3.1 million. That's a $1 million difference, created entirely through superior structure. Now I know what the astute viewers are thinking. Hold on, that $3.1 million is still inside the corporation. You have to pay tax to get it out personally, and you are 100% correct. This is not tax avoidance. The tax is still due. So for our final step, let's complete the analysis and see what the net after-tax result is in your pocket. When it's time to take the money out, the holding company first sells the investments and pays corporate tax on the capital gains. But something amazing happens here. Paying that tax creates a notional account called the Capital Dividend Account, or CDA. This account allows you to withdraw a portion of the proceeds. In our model, it's about $1 million, completely tax-free to you personally. It's a fantastic feature of our system. The remaining funds would then be paid out as a taxable dividend. So before we look at the final side-by-side comparison, let's just crystallize the core principle at work here. This entire strategy is powered by 2 fundamental forces. First, tax deferral, pushing the large personal tax bill into the future. And second, compounding, allowing a larger sum of money to grow exponentially over time. That's the engine. All right, here we go. The final bottom line numbers. After all is said and done and every last cent of tax has been paid, in scenario 1, without a holding company, our entrepreneur walks away with about $2.09 million. In scenario 2, using the holding company strategy, their final net personal wealth is about $2.33 million. And there you have it, the net advantage. Even after paying all the deferred taxes, the holding company strategy resulted in an extra $242,000 of wealth. That's almost $250,000 more in our entrepreneur's pocket. It's a material difference that comes from nothing more than intelligent structural planning. This really is the heart of the matter. It's not about if you pay tax, but when. By deferring the heavy personal tax hit, you arm yourself with a larger capital base. That larger base then compounds for decades, and the growth on that deferred tax is ultimately what creates this additional wealth. You are playing the long game. So I'll leave you with this question to consider. Understanding these concepts is the first step, but application is what truly counts. As you build your own business, your own wealth, how will you structure it to ensure it grows in the most efficient and protected manner possible, not just for you, but for your family and for generations to come?